back. Are we all here? I think so. Very interesting listening to that last discussion. We're really talking about behaviour change. And there's one thing I learned about running change programs in Reuters when I was there, and more recently for other companies. There's really four truths of behaviour change. One is it isn't quick. The second one is it isn't easy. Third one is it only happens in the front line where the real work's being done. And it only happens, fourthly, it only happens if the person you're trying to change can see a personal benefit to changing. Otherwise, corporately, they're just not interested. They want to see a personal benefit to making the change. Great opportunities as you're discovering outside for networking at these events. Remember, networking isn't a question of handing your business card out, it's hoovering up other people's. Less than 90%, according to stats, less than 90% of those exchanges of business cards are ever followed up. So there's huge opportunity out there for the few people who do follow up on the business cards that they get. That's it. Oh, by the way, if you stay tonight until the very end, a nice little surprise for you. Les Ferdinand, that well-known footballer, is going to be giving out a bottle of champagne and a raffle, which we're going to call at 5:30. But if you're not here at 5:30, then you're not part of the raffle. Oh, but that's just a way of tricking you into staying till the very end. So champagne from Les Ferdinand at the very end, if you stay until 5:30. Looking forward to it. So let me introduce, without further ado, as I say, Alissa Ostrove, Chief of Staff of Crypto Compare. Alissa.
Hi everyone, my name is Alissa Ostrove. I am, as mentioned, the Chief of Staff at Crypto Compare. First, a big thank you to Herbie and his team for having me. It's truly an honor to be here. Just to share a little bit of context about us and what we do, Crypto Compare is a digital asset market data provider that's been operating since 2014. So something like a mini Reuters or mini Bloomberg of the digital asset space. We collect and aggregate raw granular trade data directly from exchanges. We clean and process this data, and we provide our data in both real-time and historical formats, as well as provide a number of data products. We have a suite of about 40 white-labeled indices that we provide calculation for, reference rates. Our real-time data feeds are available in Refinitiv's Icon terminal, as well as NASDAQ's alternative data subsidiary, Quandl. And it's our mission to promote greater trust and understanding as an entry point to the digital asset market. We work with regulators and central banks who use our data, as well as work with us to help shape industry best practices and codes of conduct. And I want to talk to you first about the proliferation of data in this emerging market. So the chart that you see before you represents 1 week of Bitcoin trading in 2015. So every yellow dot is a trade of BTC to USD. In this week, there are about 300,000 trades. And this was back in 2015, price of Bitcoin under $1,000. Now let's take a look at what a week of Bitcoin trading looks like today. Here we have 1.5 million trades, so over 5 times that we saw in 2015. We have noticeably more volatility, and this is just Bitcoin. What about other assets? So I'm going to show you a video that demonstrates the evolution of this market since 2013. So on the x-axis, you'll see the venues where these assets are being traded, and on the y-axis, you see currency pairs. So let's take a look. First, we have Bitcoin, and then Litecoin. You'll see the red dot rising, that's Ethereum, which gave rise to ERC20 tokens built off the Ethereum blockchain, leading to the explosion of assets we see today. And not only have we seen a proliferation in assets, but also the venues where these are being traded. So while the industry has developed significantly since the Bitcoin white paper was first released in October of 2008, a product of the '08 financial crisis, we still have a long ways to go. And in many ways, this industry is in its infancy. We are navigating the road to regulatory clarity, to greater institutional adoption, as well as efficient market infrastructure. But as we stand right now, the crypto industry has a total market capitalization of a little over 210 billion. There are over 200 exchanges where digital assets can be traded. And we have over 2,000 actively traded tokens. And as a data company, we face a number of challenges. We are dealing with global markets that literally never close, that are trading 24/7. There are lack of industry standards from everything from data format to the naming of assets. But the challenge that I want to highlight and talk about today is one of trust. With an ecosystem that has very low barriers to entry, there are new exchanges popping up all the time. And any of these exchanges can be data providers. So for us, when aggregating that data, it leaves unique challenges in determining what data can be trusted in aggregated prices, in index calculation. In our sort of day-to-day data collection, we see a lot of anomalous things. Here is a chart of Bitcoin trading on one exchange over a 2-week period. So on the top you see price, on the bottom you see volume, which was nearly constant over this period and actually peaking in almost perfect intervals, suggestive of algorithmic or wash trading occurring on this exchange. This is an issue that has garnered a lot of attention in the industry, particularly this year, with a number of news articles, a number of reports highlighting the market integrity issues that a number of these exchanges are facing, and particularly that issue of wash trading, attempting to determine what percentage of reported Bitcoin trading was accurate. At Crypto Compare, in evaluating exchanges, evaluating assets, we wanted to take a step back and look at volume as a metric. And particularly in the crypto world, it's used all the time. It's easy to understand, it's easy to calculate, and you see rankings and top lists all evaluating exchanges on the basis of volume. The issue is, if we aren't sure what volume can be trusted, we don't believe that these are fair assumptions to be making, particularly when people are coming to value the credibility, the quality or popularity of exchange solely based on its reported volume. And a number of factors that are sort of unique to the digital asset space can affect volume. You see variable fee structures, you see exchanges even launching trading competitions designed to inflate or incentivize their volumes. So we wanted to assess this issue from a more comprehensive perspective. Here you see 9 histograms. So these charts are showing you the distribution of trades at different trade sizes on 9 different digital asset exchanges. So we might expect that a market that is displaying efficient characteristics would look most like the chart in the middle, where we see more trades occurring at smaller trade sizes. We see a drop-off occurring at larger trade sizes, and we see peaks at whole numbers. In this case, denominations of half a Bitcoin, 1 Bitcoin, 2 Bitcoin, 3 Bitcoin, etc. The thing about crypto markets are you see a lot of interesting and unusual distributions. If you look at the middle row, for example, on the left, you see just a weirdly smooth histogram that is suggestive that literally an algorithm has generated all of the trades on this exchange. We also see shapes like the bottom left, which shows us that most of the users on this exchange are trading in denominations above 3 Bitcoin. So we continued to study these histograms over time, and this was around March and April of this year, so this was a period of increased industry attention on this issue, and what we saw is that many of these distributions began to change. So here we see an exchange that was displaying characteristics of anomalous trading behavior and capturing its histograms day by day over March and April. We eventually come to a distribution that is more representative of what we might expect. And what this showed us as a data company was that this information could potentially be manipulated by the exchanges themselves, that if they were using algorithms to generate some or all of their trades, that it was relatively easy for them to make them appear to reflect an expected distribution. So in June, we launched what we call our exchange benchmarking report, based on data from 100 spot digital exchanges. And this is the first for us of now quarterly reports, with the next to be released next month. And we developed a methodology that was based on 7 components without the assessment of reported volume. And I will walk you through this methodology briefly, but what I want to highlight here is that actually 6 of the seven components that we are considering are based on due diligence or trust factors, with a market quality, what we call our market quality score, based on trade and order book data, accounting for only a little more than a quarter of our overall methodology. We actually found when separating out the due diligence and quantitative aspects that there was a clear correlation among those data sets. So we evaluated geography with a focus on the regulatory stringency of an exchange's jurisdiction. We looked at an array of legal and regulatory factors, from KYC and AML to licensing to insurance to custody, assessing various components of how compliant an exchange was in their particular jurisdiction. We also looked at their sources of investment. We further assessed their team and company, particularly their transparency surrounding their leadership team, which it's actually surprisingly difficult to find this information on a number of these exchanges. And we looked at the provision of data. So in this case, the ability to query historical trades and order books. We looked at API response times and rate limits, whether an exchange was offering a WebSocket connection. And we also looked at whether exchanges were implementing third-party trade surveillance, something like a NASDAQ Smarts, as a small consideration as well. And from a quantitative perspective, we assessed trade and order book data across the 8 most liquid pairs that we identified. And these metrics are really based on data-based facts about the data that the exchange is providing. So given this data, what can we infer it would be like for an investor trading on this exchange? So to evaluate the cost of trading, we looked at spreads, which, as you can see here, varied quite significantly across exchanges. To assess liquidity, we analyzed the order books to determine the depth to a 1% price impact. So what size order would be needed to shift the price by 1% in either direction. Surprisingly, on some exchanges, this was as little as $1,000. And on those exchanges, often as little as $10,000 could cause a 50% price movement. So at the top, you see exchanges with thicker order books displaying greater resistance to price movement caused by large order sizes, and at the bottom, you see those thinner exchanges more susceptible to price manipulation. We also evaluated what we call market stability, looking at the average price change over a relatively short period of time. So in our case, a 1 minute time frame was assessed. And in a traditional market where you might evaluate risk of an instrument based on its volatility, where you wouldn't expect to see much variation across markets, in the crypto world, you have a unique phenomenon where the same instrument can trade with wildly different levels of volatility across trading venues because of the differences in liquidity that we see across these venues. We also looked at a number of factors to assess natural trading behavior occurring on exchanges. So we assessed the correlation between volume and volatility, as well as calculated the standard deviation of trading volume over different time frames. As you see here, we have another chart where volume over a 1 month period on this exchange is seemingly unaffected by price change. And we did develop a top 10 list. So we gave each exchange a total score and then a relative ranking based on that score. They were then grouped into tiers from AA through to F. If you're interested in viewing a full copy of the report, you can download it on our website, which is data.cryptocompare.com. And we developed the notion of trusted volume. So rather than attempting to constantly determine what percentage of an exchange's volume was being accurately reported, we wanted to focus on what sources of data could be trusted. And for us, we assessed this as exchanges that ranked a AA, an A, or a B through our benchmarking methodology. And this is an approach that has since been adopted by other industry participants. Ripple, for example, recently adjusted their XRP reporting in line with CryptoCompare's trusted exchanges. This is something we continue to monitor through monthly reports, what we call our exchange review report, and to assess trends in this area as they develop over time. Just to briefly talk through some of the macro level findings, here you see monthly average volume based on an exchange's rating. And based on our methodology of trusted exchanges, those AA, A, and B exchanges, these are only accounting for about 1/3 of the overall volume that we're seeing on digital asset exchanges. And if you look specifically at these top tier exchanges in the AA category, these account for only 3% of overall volume. And in our view, this provides something of a venue risk assessment for investors that are interested in entering these markets. We also assessed our scores by jurisdiction. In this case, we see the top performers to be in the United States, in Korea, in Japan, and in Singapore. We have the UK sort of somewhere in the middle there. And we expect that regulatory clarity really is a kind of relevant consideration in these findings as we await that here in the UK. And the last chart I'll show you really just shows historical volume over time based on an exchange's grade. So this chart dates back to 2014. And what we see is that the trend of sort of lower ranked or less reputable exchanges entering the market is a relatively recent phenomenon. So we see these volumes reported from kind of 2018 and peaking very recently, since the beginning of this year. And our hope is that our work can help to create more transparency in this space and help to build trust as people continue to investigate this emerging asset class and exchange ecosystem. And if you do have any questions, I'm not sure I have any more time today, but I would be happy to answer any of them afterward. I do encourage you to take a look at our website, data.cryptocompare.com, if you would like to view our full report and methodology, and thank you again for your time.
Couple of questions.
Yeah, can do. Yeah.
Have you attempted to look at any of the volumes that you show here across various different platforms with that would be seen in the FX markets? Because although the FX market is obviously far more mature,
Absolutely.
you could argue that actually it has the same fragmentation that you currently have with crypto.
We have not actually made that comparison, but I think that would be certainly an interesting area to investigate.
And the other one, just to follow up, would be one of the difficulties with attempting to look at price impact for a given amount of volume that might go through is, given the fact that most of the trades are algorithmic, you don't tend to find resting orders in the market anymore. So therefore, is that really a true reflection of kind of what liquidity there is on the platform?
Well, I think for us it provided we wanted sort of a simple starting point to assess liquidity across exchanges and something that we could use as a fair comparison, but I think certainly that could be made more robust in kind of future reports. Any questions?
Peter Bennett. I don't know much about this market, but I did see Gemini some time back, owned by the Winklevoss brothers, and who were big holders of Bitcoin. And then Future was launched at CBOE, and it's actually priced on the Gemini exchange, which seems rather, through some sort of single price auction, it does seem rather incestuous to me. What do you think?
I think from a regulatory perspective, we're in a unique place where this is an industry that in many ways has been largely unregulated, and I think we will see some of these relationships starting to shift as we gain further kind of regulatory clarity in these markets.
Thank you.
Anything else? Thank you so much.